Three types of deal consideration. We've talked in the past about how structure of a deal is a very important component in evaluating whether it's actionable, whether it's palatable, whether it's good, whether it's not good. So today we wanted to talk about how that structure tends to find its way into the different types of consideration for a deal. And so when you hear the phrase consideration, it generally means the purchase price for a company. How is it broken down? And we like to think of it from the angles of both time and risk. And so three types of consideration. The first, cash at close. And so that's the cash that's given the day of the closing, which timing is immediate, risk is none. So long as you get to the closing, that money is provided and received. The second element of this is we want to look at called time-dependent consideration. And so that means there's not risk in terms of a correlation or a contingency pertaining to performance of the company, performance to metrics, other than the passage of time. And so this can still take different shapes. Sometimes you'll see what they call a seller's note, and so it's effectively a note held by the sellers of the company over a particular period of time, and it'll carry an interest rate with it. Sometimes it'll just be a straight amortized earnout, and that would basically mean, okay, over X amount of months, years post-transaction, this dollar amount is going to be paid in equal tranches. Typically what you'll hear is kind of a linear amortization, and so equal payments every month, equal payments every quarter, every year. We try to keep it as often as possible and as short as possible. But again, timing being the only thing that keeps this away from being consideration at closing. Another structure we've oftentimes seen implemented is a royalty. So figure X percent of revenue each, again, month, quarter, year, being paid until some amount of capital, or that component of the consideration, is paid out in its entirety. And sometimes you'll have a royalty situation, you can have a catch-up provision as well that says, look, once you hit a certain date, the rest of it just gets paid as a bullet payment. So different types of structures, however, the same thread between all of them being time is the only element to consider, not risk. Then the third bucket are risk components. And so when we think of that, you think of a true earnout that's either revenue-based, it could be EBITDA-based. We try to stay away from those because the operating expenses can be somewhat fungible on a post-transaction basis. But sales-driven is often a way that it can quantitatively be gauged and evaluated over a period of time. And then also there can be metric-driven earnouts. And so you can see that from customer retention, customer conversion, the attainment of new customers. And so oftentimes, again, it will be kind of sales or top-line heavy because, again, if the sellers do not have control over the operations of a business, you really want to try to avoid making any of the earnout or the consideration of a deal contingent on any of the operating elements other than oftentimes the sales, which the pre-existing funnel will have a heavy implication regarding. And so again, you're going to have to deal with how is it calculated, how is it paid out, over what duration of time. And again, with any type of post-transaction consideration, we want to try to keep that duration as short as possible. The phrase goes, the only thing we really know about perfect storms is that they keep happening. Therefore, the shorter the duration of time, implicitly lower the probability that a perfect storm happens. And therefore, we want to try to keep those tight and short. And so that's a thought for today. The three types of consideration. You have cash at close, zero time, zero risk consideration. You have time consideration, whether that's a seller's note, a straight line earnout, a royalty payment, or you have time and risk considerations. Those could be metric-driven revenue, EBITDA that we try to stay away from, customer implications, other things like that. But again, something that both has a downside risk, and when we're representing a client, we also want to have an upside risk as well. And I'd say, just to add to that last component of it, the idea of an equity rollover or just selling 80% of the company and then keeping 20% in the next iteration of ownership is kind of the purest form of risk consideration as well. So different things, there's certainly a lot of depth and granularity within each of these categories, but if you can generally think, okay, we're going to exit the business, how is the structure of the consideration going to come to us, you can usually put the different elements under one of these three buckets. So that's the thought for today. Hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.